All right. Good morning, everybody. You won't see it in the economic calendar, but we get GDP today. That's going to be one of the biggest things. I say it all the time. You can go to 50 of these websites and look at what's on the table for today. It doesn't necessarily mean that you know what all the economic events are. Depending on which site you go to, it may only do the biggest highlighted things and only US markets. It may do all the markets around the world, but still only get key things. And you can check them all. You won't get them all. There's economic events that are coming out 24 hours a day on the half hour, on the new hour, and even sometimes on the quarterly hour. And then there's markets that are continuing to open constantly. 8 and 8:20 in the morning is when treasuries open. So you see the dollar, 10-year, things like that. It's just nonstop, right? It's one of the reasons I continue to say, watch the clock, because you can spin your wheels trying to find every single economic event that may hit today and try to figure out when it's going to hit and if it's going to have an impact, and you still wouldn't get them all. Or just watch the clock and realize that every half hour and every new hour, we have the potential to see volatility. And so if you're using tight stops and it's a new half hour or a new hour, you're very likely just going to get wicked out. Markets have been in a range now for a few days. The picture that I continue to kind of put in front of everybody is the range on the S&P right now. You can do the same thing with SPY. Bring this picture up. I put it on my Twitter. That's the zone, right? Now we can tighten that up. As you see me do it every day, we can just draw that exact same zone on the current move of the market, right? This little inverse head and shoulders that we have forming this morning. We could tighten the whole thing up, but even if we did tighten it up, the top of the zone right now, it wouldn't change. It would be the same thing. The half back would become the bottom of the zone, but it would still be a critical level. So we got to get out of this box. GTFO, get out of the box, right? Until we do, what we've had since Thursday is what we're going to continue to get. If we take this out to a daily time frame, this is IX10, inside day over and over and over again. The longer we stay IX10, the more energy we're building up. Energy is kind of a weird word. You know, most of the time in trading, you hear trend, momentum, inertia. You don't really hear the word energy, but it is a thing. And we really learned more about energy when we started using that RSI Laguerre indicator. Binomial, fractal, just twist your head around. It gets into rocket science math, and it's crazy. But that tool showed us when markets go sideways, they're actually building up energy. The analogy that I use is when the market makes a move, we want to know, is it moving to make energy or is it moving spending energy? Because another thing that indicator showed us is sometimes the market will make a fast, sudden move in the opposite direction, not necessarily saying down. It'll just move in the opposite direction. And that inverse move is where we build up energy real quick. So if you take a ball out in the yard and throw it, you put energy behind that ball and it's flying through the air, losing energy, and it finally hits the ground. It makes sense. It's common logic. Take the ball to a tall building and drop it off the top of that building. As it falls, it picks up energy. So in one scenario, the ball is moving but losing energy. In the other scenario, the ball is moving and building up energy. It's the same thing with price. You kind of want to know when price starts to break out and run. Is it breaking out and running with energy behind it? And that energy is dissipating as it goes. It's burning energy. It's just like your car burns gas and then you run out of gas, the car stops. Price runs out of energy and it stops. So is the breakout with energy behind it fueling the push and driving it forward? Or is the breakout a move that's generating energy? When we come out of this IX10, we will have a lot of energy behind us. There's no directional bias to that statement. Don't care if it goes up. I don't care if it goes down. I just want it to GTFO so I can trade it whichever direction it goes. So we can look at the crystal ball all we want and try to hypothesize on whether it's going to be a top side breakout or a bottom side breakout. But at the end of the day, you don't know. I don't know. Nobody knows. All right. That's the way the world works. There's no crystal ball on the markets. Best we can do is be prepared for the move and have our targets and levels in place and a plan to trade it no matter which direction it goes. We do have some auctions today, and we have more Fed speakers chipping their teeth. Surprise. What we don't see is jobs data today. We're going to start getting into that tomorrow. So while GDP today is one of the biggies, the jobs data tomorrow is even bigger. One of the things that we continue to focus on are these events in our markets that put us on pause while the market waits for these events to get here. And we're in that sort of scenario. We're not sitting sideways in an IX10 pattern because the market wants to. We're sitting here waiting on data. And until we get that data, we're going to continue to sit here. Even the news that we've seen that normally would have rocked the market didn't break us out of the zone. It wicked us out and we came right back in again. So keep your eye on the clock. Continue to look for economic events that are coming up to see where or when this breakout could happen. And other than that, we're just waiting. Waiting and waiting. So there's the range. It's pretty clear. 5,800 to the top side, 57.50 to the downside is like the halfback, and then 57.31 cog line around that 10-day moving average. That's the low end of the zone. Those are all key levels. 57.32, 57.50, and 5,800. 57.92 cog line, right? That lines us up on all of this. We're ready to go. It doesn't matter which way. All we got to do is get it. It is interesting to note that they were talking about new highs. And you look at the ES, our high was back here on Thursday. We haven't had, quote, a new high. Take a look at the SPY. We didn't get a new high. But we did in the SPX. When they said that this morning, I was thinking, what new high? I didn't see a new high. What are they talking about? They must be high. That was the new high they were bragging about this morning on Bloomberg, I believe it was. We wicked out of it. Just this tiny little wick, and then we came back in again. We did get a significant amount of CD into the close yesterday, which I posted that chart, pointed it out. The carry trade started to get a little bit of movement as well. We're starting to fade that back off again. At the 10-year with that little J hook, and the dollar, excuse me, the 2-year and the dollar with the hook, the inverse head and shoulders on the ES in the wrong spot, but it did play out, got the half. And we had the carry trade on that lift up, basically from the ES lows. It's where this low lines up. It's where we started the run, but we've already started to fade out of the carry trade. We want to see that exuberance, right? We don't have that yet. So we're basically flat. It's not a surprise after everything I just said. We're above all the major moving averages. None of them are a threat. We have the call wall up there. If we fade to the downside, we've got that 57.50 and then volatility trigger, 0 gamma, and put wall way down here, 54.50. Because we're basically flat, we really don't have any edge for one side or the other. Could we go to the upper ADR, the lower ADR? We really don't have much on either side of that. It's worth noting, if we go to the lower ADR, it lines up really well with yesterday's low. So we'll get some confluence there and a little bit of support, some unfinished business. And it's really close to 57.50, which is one of those key options levels. So a downside move's got a lot of structure to it. The upper ADR seems like a long ways away. To get there, we've got to get through the roundy, 5,800. Well, the COG, 57.92, then 5,800, then 58.11 COG. Then we can get all the way up here to 58.28, which just seems wild. So those COG lines aren't necessarily resistance the way that we have these ADRs and yesterday's levels as support, but they will be liquidity zones. Taking a look at the CPR, this is a floor pivot with a mathematical calculated channel above and below that floor pivot. These are not the same as S&R lines. If we open the indicator up and we turn on the S&R lines, then you can see these red and green, also math formula built pivot levels for support and resistance, but that's not these, right? These are just math defined channels, and how wide they are or how narrow they are gives us an implication of what kind of price we should expect today. Are we going to break out? And if we do break out, would the breakout have legs and continue to run? Market theory suggests if the channel is very narrow, breakouts can run, that they can grow legs and really get. And if the channel is wide, that will stay range bound and that breakouts will fail. Now, these channels don't make us break out. They don't make us fail to break out. They're just giving us a clue or an idea of what should happen if we actually do attempt to break out today. Spot Gamma's Gamma Index does the same thing, whether it's a -4 where breakouts can grow legs and we really run, or a +4 that says any breakout we get likely fails and we fall back in again. It's just a perspective on how likely is a breakout to stick today, because that tells us when we get to the upper edge, should I sell into strength? When we get to the bottom edge, should I buy into weakness? Or should I jump on the bandwagon and continue to sell it and or jump in with all the buyers and buy it on the breakout? base case argument is we're going to hold the line and stay in this range until we get the econ that the market is waiting on. I kind of have a feeling that that's tomorrow's job numbers, but it very easily could be today's GDP report. And I think we're going to find out, because if we get the GDP report and we break out and actually go somewhere, then ta-da, it was that. If we don't and we continue to stay in the range, then nope, it wasn't that economic event. It must be one of the other ones. Very likely the job numbers. Today's range opened higher than yesterday's. They're not touching at all. That's considered bullish. Price opened above the central pivot range, CPR. That's also considered bullish. But the range is wider than yesterday, which does imply if we attempt a breakout today, that breakout likely fails. I'm going to add to this and say that a channel or spot gamma's gamma index or anything else that exists out there has no impact when it comes to an economic event. So this can say we're going to be sideways. You can get 50 other things that are going to tell you we'll be sideways, and then econ can come out and trash all of that, and we can break out and rip. So always keep that in mind. To get the GDP, knowing that today's the GDP report, you can see it in the Spot Gamma's founders note from last night. For an example, that's one place. It says it's going to be at 8:30 this morning, Thursday, September 19th, in the upcoming market events. So read the PM Founders Edition notes. You can also go to the government.fed website and see it there. But I would say check the Founders Note, the PM edition. It was right up at the top. Yep. Those little details that get us, right? There's just so many things to read every day and try to prepare for every day. It's easy to miss something, which is why we help each other out and post those things. Because guys, I miss things all the time. You'd be surprised how many times one of you send me something and then I say, oh shoot, I didn't know that. Good to know. Thank you. Volume profile. This profile is set for the week. So the one that we're looking at here from last week is really the defining edge of what we're working on right now. Should we break to the downside, as I've mentioned every day this week, 5,700 is what we have in the ES. We break under that and get through the 5692 cog line, it's game on to the downside, and I like 5550 after that. There's not a lot down there. If you look at the gamma models, GEX, DEX, you know, the confluence levels on spot gamma, there's really not much down below 68, 70-ish. But I like the, 5692 cog. That's kind of my line in the sand. So if we are headed that way, I think we'll get there really fast. On the other side of it, there's really not much on the profile for anything over our head. So this point of view is really only helping us for our downside analysis. Volume looks good from the overnight. 60,000 is fine. It doesn't stand out as overly large. We still don't have a market maker move, which is one thing that makes me think the market's not waiting on this, right? As much as I'd like to believe that, oh, it's GDP and we're going to get it today and all good. If it was, I kind of expect them to be hedging, and they're not. That doesn't mean that the GDP won't move us. We've seen many times that there's an economic event on the horizon and it does not directly connect to hedging, that they just don't hedge into it. Like they think, it's all good. I don't need to hedge today. And then they don't. So I don't like that I don't see it. So that's where my little bit of bias says maybe it's not going to be GDP. The London high matches pretty good with the Tokyo high. 57.92 cog line. If we didn't have these session profiles, it would still be 57.92. So to the upside, that's the level that we have to get through, and then the rounding. Europe set a lower low than the Tokyo low through the kill zone. That is lower than the 57.92 cog, or even the next thing lower than that is 57.50, which is a long way off. So as I had mentioned, there is a halfback here for this entire zone. And I would focus on that halfback for the whole zone as the level to break through if we're going to trade into the lower part of this. 57.71. Yeah. Is it tomorrow? Great. Then it's tomorrow. That would explain why there's no market maker move, and now I feel a little bit better. Good. That is good. Then maybe it's the revision numbers. There's something GDP today. I will find it and I will put it in the chat. I have an app on my phone, by the way, that does a really good job at giving me the GDP stuff, and it's a free app. I will post that in the chat as well. And it's just an app that connects to the government website. It's called Economy Now, but I'll get a picture of it so you guys know what icon to hit. 25th. Yeah, maybe it's the GDP estimate, right? It'd be like one of their hypotheticals of, oh, we think it's going to be this, but it's not the actual numbers. But I'll get that and put it in the chat. But good, because without that market maker move, it was frustrating me. I keep thinking if it is going to be the GDP, where's the hedging? So no hedging? That makes sense if it's not today. 10-day volume profile. No change, no expectation to change. It's the strongest thing. And if you look back, there's nothing else. It's been a while since we've seen it this condensed, this tightly constructed. Nice, perfect. You know, I haven't gone there very much lately when it comes to looking at economic events. It gets to the point where Thinkorswim really doesn't do a good job. But there it is, 8:30 tomorrow, GDP. Perfect. Teamwork. So this profile really stands out. I can't remember the last time it was such a classic, very clean P-shaped profile. This point of control is not going to move anytime soon. It is worth noting that it's not really acting as a support or resistance level. You can see how we're cutting up and down through that zone over and over again. So it's not supportive. It's not resistance. Not now, because we're hanging at that level. But if we leave this zone and then we come back to this level, we can then expect it to behave more like a support or a resistance. So if we come down and we get into that 5,700 and then we try to run back up, it'll be resistance. But if we break out above 5,800 and say get to 5,811, and then we fade back down into this, it'll be supportive. Potentially resistance, potentially supportive. That means we're going to get GDP tomorrow while we're also getting job numbers tomorrow. That's definitely what the market's waiting on, right? When you put those two pieces together, this entire range that we're doing here, sitting here all week, we're waiting on that. Oh, yeah. Five-day, 5-minute profile TPO shows the same thing. We don't have anything that stands out here. The little inverse head and shoulders play, it's already done. If you were to do the measured move, we've already made it. But now that we're back up, we're near the point where we have the potential for a cup and handle. If we focused on just yesterday, then we've already tested the halfback. We don't have a VPOC to carry forward from yesterday because we've already cut through that level. And we don't have any to the downside for a long ways off. 5,600 isn't going to do us any good. You know, speaking of call wall, I know I focus on the ES a lot, but I know traders that trade the SPY, and so I tend to help them out, you know, draw up some charts for them, whatever. That that 570 level, man, Monday, we just kept hitting it and hitting it and hitting it, and we couldn't get through it. But it's not just the call wall. That's like the zero gamma level. So SPY had that double dipped there, and we just kept hitting our head on it. We finally got through it yesterday. Now the call wall is at 575. So a little bit of a heads up for you SPY traders. It went from 570 yesterday to 575. I always consider the rolling up of a call wall to be a bullish bias. If I'm making a scorecard with a check mark on is this bullish or bearish, that goes in the bullish category. And then I look at the put wall and I ask, you know, did it roll up or did it roll down? And if it rolled up, I would consider that a bullish check mark. If it rolled down, I would consider it a bearish check mark. I can check the map and let you know. I don't know if the volatility trigger rolled or not. I know that zero gamma is where it was yesterday, so I know that one didn't move. But I don't know if the VT moved or not. I'll let you know. Yeah, because the founder's note shows whether or not they moved, but it's for the SPX. So I can go in and use the tool and I can change that map and look at SPY, I think. I don't see why I can't. If not, I've got the previous day's spot gammas. You can always go into those, right? They're in the chat. Just go back to a previous day and read the founder's note and see what SPY's volatility trigger level was versus what it is now. I don't think it moved, to be fair. So we're in hurry up and wait mode. That means 80% of the market's going to be in hurry up and wait mode. And I say that, but we've seen some really good moves in the last few days of a lot of companies making some jitters. MU's going to report. That goes to the heart of what's happening in semiconductors. Intel is still a potential M&A candidate. They were talking about SOX today on Bloomberg, looking directly at the Philadelphia Semiconductor, SOX. So semis are kind of a big deal, front and center, as they have been. Over the last 5 days, they're up, 5.25%. So even though they're down a little bit this morning, I mean, after a 5% move, kind of figure they're going to be. Google, Amazon, the whole Mag 7 group, still up over 4% over the last 5 days. They're kind of flat this morning. China's up 14% over the last 5 days. It's down 2.5% this morning. I've seen a lot of posts that said that fell flat on its face. There was all the talk about, oh, wow, the big China stimulus bazooka. And it didn't reverberate around the world and didn't last 24 hours. And now we see the China KWEB constituents down 3.25%, which, by the way, it's still up 16.75, which means it was up 20% in the last 5 days. That's a pretty big move. It makes sense to expect a little bit of digestion after that sort of a move. But as I've been arguing, even if it is now time finally to start getting into the China names, expect some pullbacks because it's just not going to be like a straight shot. So we don't have those today, and we did yesterday. We don't really seem to have the gold miners and all of them today, which we did yesterday. We got nothing. The VIX is up. But it's still within the zone. These levels, by the way, they're from David Keller over at Stock Charts. He had mentioned one day that these are his levels. He's kind of made them up over the years, and it suits him well. And I threw him on the chart and thought that's a nice, clean little snapshot for where volatility is. But to me, it just seems like it's missing some stuff. So I'm probably going to put lipstick on this pig over the next week or two, and I'll share out the new chart. Just some levels in between these levels, right? They may be a bit more transitory. They come and go, but I just think we're missing something here. Still, from the way that Keller presents it, where we are in the S&P environment is still just a pullback. It is worth noting the SPX made a new high yesterday. So what pullback, right? That doesn't even match. We shouldn't be seeing this sort of volatility with a market making new highs. I'll make that argument. And we keep looking for the next trigger. Someone shared an article about a strike at the ports that is looming, and it's a big deal. Like they're working with the unions right now trying to avoid it. If they don't get that done, the walkout looks like it's planned right around the election time, and it could throw the whole holiday season right onto its face. That's a sneaky one that is looming in the background too, right? That would jack up supply chains. Man, just so much. For things that are up, we got nothing. For things that are down, the China ADRs, China itself through the FXI, crude is down 1.25. I continue to be bearish on this too, by the way. Airliners are down. That's just a big gap at this point with, it's just a print. We want to actually see some flows. So I wouldn't get too hung up on where you see it at the moment. Bitcoin is down, silver, precious metals, emerging markets, pot stocks. We got nothing. We got a marketing chaos. And we're waiting on data. So don't get too heavily invested in the names that you see moving. If we do get this breakout one side or the other, we're very likely going to see a significant capital rotation from one direction to the other. That'll be like out of defensives and into Mag 7 space type names, or the other way around. We see a heavier dip into the defensive space and more money exiting out of the Mag 7 space. There is the argument for the upside move that we can see, quote, the everything rally continue to broaden out and that we see everything go higher or lower. There is always that. But if we're looking for a change in market dynamics, we can see defensives over the last 5 days and even just over the last week or so. We set that high at 160. We've been kind of fading back since then. Lower high and lower low, or almost another lower low. You see this move to the in energy. It's been since April, just lower and lower and lower. All right, everybody, you got the levels, you got the bias. We're going to hold the line and wait for data. Be careful, be safe. I'll see y'all tomorrow.